Nate, why don't you give us a background on yourself, how you got into the position as you are at partner at Rust Belt Capital, and what
Sure.
you do full time as well?
Sure, no problem. Me first and you second? All right,
Of
okay,
course,
okay. All
right?
right, all right. Nate Spitler. I practice law in Bowling Green, Ohio, a firm called Spitler Huffman. It's a family firm, started back in the 30s by my grandfather. Six full-time attorneys at the moment. Born and raised in Bowling Green, went off to school, came back to join the firm and after
Where did you
law
go to
school.
school?
Did my undergrad work at Cornell University, Big Red. Came back and went to law school at Toledo. Really decided that I wanted to be in the area, and Toledo's the local law school. And so that was kind of at the time, my older brother, Andrew, was in law school at Toledo, so that was pretty fun to reconnect there. He'd gone off to university, and then as did I, and then kind of reconnected and got to spend some time together there. He was doing a combined JD MBA program that University of Toledo has. So while he's 2 years older than me, he was only a year ahead of me in law school. So that was kind of unique scenario. And actually, through that, my brother and I got into real estate early on, right when he was just getting done with law school. I was still finishing up, and we bought our first rental properties together, and that's
What year
what
was
led me
that?
down this road. That would have been 2006, 2005.
So right
Right in there.
before the 2008.
It was right before, yeah, it really was. We bought our first few places. I don't want to say we were the cause of the bubble, but money was free in, I guess, 2000s. In 2006, you could get a 103% loan on
What?
a house. If you have an appraised value of $100,000, you can get 103% on that. No money down. We actually walked out of closings with money that we didn't put any money into it. Well, everybody knew back then that housing values only go up. They can't go down.
Clearly, that didn't work out too well.
It worked out just fine. We still have, actually, we've never sold anything. We still have all of our places that we accumulated over the years. But our margins were thin because we didn't have much into it. But they cash flow and still work. So that's how I got my start in real estate. And quickly learned that managing your own residential property is a pain in the rear.
Yeah.
It's no fun. I don't say it's no fun. It's hard work. It's not just buy a place, sit back, collect your check, right?
Yeah.
As you know, there's a lot more that goes into it than that. And that, I'll give you a good background. I manage 23, 24 units, I guess, depending on how you count duplexes and so forth. But that's where I got my start. So practice law, we have our firm and managing member at Spitler Huffman, as I mentioned, and our title business that goes with it, and then the real estate ventures on the side, and then along came Rust Belt. Really along came, our conversations that led to Rust Belt. But
So I'll give a little background on myself. My name is Steven Speck. I grew up on a 1,000-acre row crop farm here in Northwest Ohio. And I always thought I was going to be in commodity trading. My father was in commodity trading, grew up on a farm, agricultural products or commodities. So I went to Ohio State for university. I ended up getting 2 degrees from Ohio State, one in ag business and one in cognitive neuroscience. Because those go to...
it always makes me laugh.
Yeah, those go together so well. But I guess I really like learning. And through that, I had some different opportunities to go do some internships. Worked as a futures broker in Chicago. So that's high leverage. You're putting together trades for individuals on the commodity aspect. Super high leverage. And I learned a lot about that business. I also learned I didn't want to be in that business because as a broker, it's a low margin business.
Right.
And really that industry is fading away. Then I had the opportunity to go work for Cargill out in Kansas City as an intern. Cargill's the largest agricultural commodity trader in the world.
Yeah.
So I got to sit on their trading desks out there and kind of see the business. And I saw it's a commodity business, so it's really low margin and it's consolidating. And I'm sitting there and I'm like, okay, if I go make a trade, I can make money on this trade, but I make money one time. And then I have to go make another trade. And if anybody starts trading, they realize not every trade you make, you're going to make money on. Okay, it's a very tough and stressful business. And I said, I'd rather have the ability to sit and wait for only good opportunities, make one trade or one decision once, and continue to get paid for it.
That can last. Yeah.
Right, and so that leads you to investing. Well, that's what investing is. So that led me down a hole, basically, of learning everything you can possibly learn about investing. I was looking at and going to go work as an investment banker, but I'd managed my own investments to the point that it didn't really make too much sense to go do that. And really how you get from that into this real estate ventures is like, okay, you can go and invest in the stock market, but you don't have the ability to use leverage.
Right.
Because you got a margin call potential. And so I needed to find a really simple business that's easy to understand, because it needs to be easy to value for both me and people that you're borrowing from, which is the leverage portion. And so that led me to real estate, and led me to the idea of scale. And ultimately, I start making some real estate investments and start doing really well on that. And then, a good opportunity came about with our first investment, which was a 64-unit apartment complex. And that really started what is today Rust Belt Capital. I remember coming to you, Nate, and having this property. I'd underwritten the property, knew the numbers on it. And I don't know if we were sitting down at lunch, but I was like, basically, I'll put in, I don't know it was a large amount of money. It was a large amount of money. And I was like, but I still don't have enough for all the down payments. It's something you're interested in. And I don't know. Well, apparently, it must have been a good enough pitch that you were like, all right.
Well, yes, because a little more detail on our, I guess, background. And this is, I think, kind of fun. When I was graduated law school and started practicing, and then a few years later, I kept in touch with a family friend that ended up taking a head coaching job at local high school, and I joined his staff. And obviously, you were one of my players. Let's see, that would have been 2013. Is that right? 13.
Because you played at
season?
the collegiate level. You played.
I did play in college.
Yeah.
So I think I have a little bit of a clue, but
just a little.
Able to pass down some of that, and so yeah, when that was so much fun in that respect. And if I can inspire anybody to go give back at the coaching in the coaching world, if you have some skill, that is fantastic experience to see, young people absorb what you're telling them and then take it. That gets off track from what we're talking about here today. But great experience. And then obviously we stayed in touch. And when you had approached me at first with this real estate syndicate, I said, all right, I'll listen. More out of respect. And my gut was, okay, I'm going to give this kid some guidance, right, on what it's like, where he's got this thing screwed up or missing the details and so forth. But once we sat down and started going through it, it started dawning on me, like, well, dang, this is actually good. This is well thought out, well put together. The numbers made sense, et cetera. And it wasn't just conceptual, because you had a specific target in mind, and it was a unique setup. I think that first one, and why it really came together for us was because that deal had fallen apart. The apartment complex that we first acquired had been under contract previously.
They tried to sell it 2 times. Yeah,
yes,
and it failed.
And it failed because reasons that were not ours. That fell apart. And so you had done extensive homework on that. And then after going through it, it made good sense. And I guess the biggest pushback that I gave you on that first one, and I think I continue to, is always your maintenance projections aren't enough. The maintenance, remember if you recall that.
Yeah.
But no, you had a great business plan, and then, well, we jumped in both feet and hadn't
Closed
looked
the
back.
deal, and
Yeah,
so far that's probably one of our best investments.
it's been great. Yeah.
I think our investors like that a lot, and it seems like if we could bring them deals like that,
All day long.
yeah, all day long, they'd be all after that, because it did what we said it would do, and
And I think that's big. When we approach investors, it's a little bit of sales, but at the same time, if you have a product that is good enough, it sells itself. And that's really, I think, what a lot of it boils down to. What do we always say? Good assets leveraged in time, right?
Yep.
Once you explain that philosophy to people and what sets us apart, when you have accurate numbers and accurate projections, intentionally, I don't want to say undersold, but intentionally careful not to stretch anything. We don't want to misrepresent anything to anybody.
Yeah.
Exactly. And project against yourself so that you're sure you're going to hit the numbers that you're giving people.
exactly.
And once we're able to present that, and I think you do a wonderful job of presenting in those situations and breaking it down so that anybody could understand what we're doing and why we're doing it and how the whole thing's going to operate. I think that goes a long way as we can get into in more detail and on other areas. But yeah.
Yeah, I mean, it was that first investment was one that I wanted to do regardless. Like, I needed to figure out how to put the deal together.
Some way, somehow it was
Some
going.
way, somehow. And I was willing to figure out how to come up with, I don't know if it was 40% of the equity that we needed or something, which is a substantial amount of money.
Right.
But I think that spoke a lot because, like, first of all, you have that money, and then second of all,
Right.
you're willing to put it all into the.
Put your money where your mouth is.
Yeah,
Right?
so-
That's right.
We still do that today in the projects we take on. We invest in the projects with our own cash and capital.
Well, for a couple reasons.
Yeah,
Yes, it shows investors that we have skin in the game, which I think is helpful, comforting for anybody. But number two, because we really believe it's going to work, and why wouldn't you be an investor in something that's
No
going to work?
kidding. Yeah.
It only makes sense.
we're not doing this. We don't own Rust Belt, or we didn't put Rust Belt together to make a fortune off of fee income.
Correct.
We made it because it's an investment avenue, an investment vehicle that we ourselves are investing in, and we want to open it up to like-minded people. And
right.
the like-mindedness needs to come in the fact that you believe in good assets leveraged in time, and that you want to commit to some type of an investment that is a long-term investment that 10 years from now, you want the dividend income coming off of that.
Right.
You want the ATM machine that you're building.
Exactly.
Something that's reliable, steady, and so far we've never missed a distribution payment.
Right.
That's something that I'm very proud of,
Absolutely.
and it also matters to me because that's where a meaningful amount of my income comes from. Is
Sure.
these distribution payments.
Sure. And that's what sets Rust Belt apart from a lot of other real estate syndicates that are out to make a quick return, get the asset value pumped up as fast as they can,
Yep.
which really benefits the syndicator over the investors. And
Yeah.
when you're on both sides of it, as an investor and as the operator, that long-term approach that we take for that ATM machine analysis, I like that term. That's the right idea. It's creating more income streams, and who doesn't like more tax-efficient income streams?
Yeah. I mean, I don't know. This is where I invest primarily in these assets. We don't do side deals.
Right.
Like, we're not going to go buy real estate outside of what we show our investors.
Right.
So when we go find a deal, we believe in the deal enough that that's where we're putting our money, and we're going to do the deal whether investors come along or not, which should speak volumes
Yep.
about what we believe in, what we're doing. But The other thing I like about this and what is really appealing is when you get bigger, you get scale, you get efficiency, and
Yes.
from my experience, I've literally been in the situation where you're trying to borrow $100,000 from a bank, and I'm trying to borrow at the point it wasn't $1 million, it was like $2 million, right?
Right.
But it was way easier to borrow $2 million from a bank than $100,000.
Right.
And if you think about it,
Makes sense.
it makes perfect sense, right?
Yep.
It's the same amount of time for the bank to do the underwriting and all that type of stuff,
Yep.
and do all the paperwork. But one has way bigger payout than the other for the bank, and one moves the needle.
Or you could do the same work 10 times or do it once and
Yeah.
have the same result. So that's, makes a lot of sense.
And Nate, you own what is it, 20 or 23 on your own?
That's what appeals to me for a variety of reasons, but one particular avenue is that scalability, like you talked about, and the leverage. Because when we go into any deal, we're looking for a way that we can gain an advantage, right? Whether it's the place is under rented and we can increase the rents and see some return there, or whether it's just operated inefficiently or poorly, right? Whether they're wasting money. And not that I don't want to imply that we wouldn't maintain something, because
Right.
we want to have high quality places to live, not just for asset value, but for reputation and all the right reasons. But a lot of times, how many times have we seen offerings where somebody's sitting in an office getting a paycheck, doing nothing or not as much as they could be?
Yeah,
So
you're
those operational
overpaying for what they're
efficiencies.
getting. Yeah.
Yes. And then, not to mention with size, you gain access to capital at better loan terms. Loan terms obviously matter a lot in this game. So for all those reasons, and then frankly, the biggest one for me is not getting that 3 a.m. phone call, not having to deal with those tenants. As you know, on the investor side, you are just an investor, not taking that personal guarantee, with Rust Belt absorbing that personal guarantee. So our investors are no different than the stock market. You are an investor. Yes, there's risk you can lose your money. There's risk you could make. Bad things could happen.
You could go to zero, but you can't.
You can't go less than zero.
Yeah.
Less than your investment.
The most you can lose is what you invest.
Exactly.
Right.
Exactly.
So that's a big win, I think, for investors.
Absolutely.
And then on the multifamily space, like, why do we specialize in multifamily? I think we had an opportunity to invest in some mixed-use properties and stuff like that.
Right.
And we said no,
Yep.
very strategically. Why did we say no to that, Nate?
Well, the scalability is what it comes down to. You have a great video out there that you did a while back, talking about, if you go by one place, right, and that one tenant moves out on you,
Yeah.
your income goes to zero. If you have 64 units and one tenant moves out,
We've already
not a
accounted
big deal.
for it.
And you've already got, because you're constantly dealing with just normal turnover, you've got 6 applications sitting right there too.
Yeah.
So it's immediately filled. If operated well,
Right.
when operated well, and you don't have that loss of income. It's all factored in. So I think that adds so many assurances.
We just
It's huge.
remodeled a unit in one of our complexes,
Mm-hmm.
and it's a smaller complex, but it was down for a month, so pretty quick
Right.
turn to do this upgrade.
Yep.
But our investors are still going to get a distribution check next
Doesn't
quarter,
change.
even with one unit being down
Right.
and being upgraded and all that type of stuff. You're still getting paid.
Right.
Versus if that was a house and you only have 2 houses, you're 50% occupied then.
Yep. And
So-
you're down for that month of income matters a whole lot more than if you've scaled that out.
Yeah, and our ability to negotiate with contractors to get it done, like, they would much rather work with us because everything's standardized, everything's easy. We're not, finicky and wasting their time, and so they know
Exactly.
that they can be more efficient. So they give us better rates than you would normally get.
These PTAC units are a great example of that.
Yeah.
That we ended up going out and buying. How many did we buy? We knew when we acquired the property, we were aware that we needed, I forget, to replace 3/4 of the units.
HVAC systems,
The
yeah.
HVAC, and then when we knew it was okay, so let's, instead of buying one for example, $3,500, you buy 20 of them, and they come out to $2,500 a piece.
Right.
So those efficiencies.
And then the maintenance on, or the labor, I should say, on installation. Okay, it's much more appealing if I've got a ton of them. They're all the same.
Right.
And once I know how to do one, I know how to do them all.
You're getting better rates on the install.
Yeah, you're getting way better rates on the install. And so we've been able to save a ton of money than if we had to go do that retail.
Absolutely.
On that one. I would say the thing that's appealing about multifamily specifically, it's not just that it's, from an investor's perspective, passive income, or that you don't have to take on the personal guarantee for the debt, or you don't have to worry about the 3 a.m. phone call, or we like multifamily because it's a product that's inelastic. It's like insulin. Everybody needs a place to live, okay? That's not, that's all great things, but really the things that we really like about it, the reason we say it's a good asset is because of the ability to increase the value of the asset based on its cash flow. So a great example I use a lot is, say we take a 60-unit apartment complex.
Sure.
And the capitalization rate, meaning if I paid cash for this property, this is the percentage return I would get on my money, is 8%. So if there's $1 million property and I put $1 million cash down, I'm going to get an 8% cash return on my $1 million. So if the cap rate is 8%, we have a 60-unit apartment complex, and we raise the rents by only $25 a month across the board, that equates to $250,000 in new value. Immediately, overnight, that's not arguable. It's there. Okay? And we've definitely done way more than that on properties. And so that gives us some, when we look at properties, with that scale that you can't get with a single family house, okay, we can step in day one, and one inefficiency might be they're not billing for their utilities.
Sure. Yep, we've seen that a lot.
Immediately, boom, hit them with $25 bill back utilities. Boom, we just increased the value of the property by $250,000. Or we've reduced our expense line, and we can raise rents too, because it's not truly rent, but it is revenue per door. So that's some creative ways that we can force the value of the property to go up. But if you have a house, the most the house is going to be worth is whatever your neighbors sold their house for. It's based on comps. So even if you have a house that rents out for $20,000 a month, if it's in a $200,000 house neighborhood,
that's what you're going to get.
Yeah, maybe you'll get 300. I don't know, but like
that, not near the return. That's right. That's right.
So it's really important to know that it's not necessarily how hard you work, but it's the opportunity vehicle that you're in.
I think that's a good way to put it.
Get in the right boat, you won't have to row as hard. And so that's what we're trying to do, is get in the right boat, we don't have to row as hard, and then we can get better than average returns.
Fair.
If an average return is 8% in the S&P 500.
I think that's definitely better, but yes.
Yeah. So I mean, I don't know. Why do you invest in this instead of going investing in the S&P 500 or other things like that?
Well, fairness, I will not say that I have no market exposure. That's but as any, and I am not an investment advisor by trade, but anybody that I've ever listened to, read information in investing is diversification, right? Sure, have some money in the market, have some money in a variety of different things, but the real estate's a nice piece, and it's a great piece, tax efficiencies and otherwise, but I like it more than anything else because of that control piece of it. I can't control what IBM does. I can't control what, I don't know, Tesla, Microsoft, name your Fortune 500 company, right? They're going to do their thing. But when you have real estate, you actually have control, and then there's the responsibility that comes with that. Of course, under your control, it could go bad, and obviously that's not what you want to have happen. So there's more involvement with it, but it is, you can actually go touch and feel, and you've got something tangible there, as opposed to some stock certificate that is only worth what that company, whatever that company does.
New York Stock Exchange says it's worth that.
Right, completely out of your control. So I love that aspect of it.
Yeah, and I think in the era that we're in right now, as inflation's a big thing.
Yes.
I would say when you're in residential housing, when that is the product you provide,
Yes.
you've got a lot of insulation against it. So since 2020, they've printed one third of all currency in circulation today was printed since 2020.
Yep.
And what that immediately did was shot up all asset values.
Yep.
Okay. So yeah, the stock market went up. But if you owned a house, look at what housing values have done.
Going crazy.
Yeah, and the correlation between money printing and the value of these assets is like 0.85,
Yeah.
which is pretty darn highly correlated. Okay, and so if you're invested in those types of assets,
Right.
you're going up by inflation. But even more so, if we break it apart even further, and we look at the CPI, which is the inflation measure,
Right.
and you look at the line items of it, and you look at the shelter one,
Right.
last month. The CPI came out and it's 3.5.
Sure.
But shelter was
huge piece of that.
Shelter was 6.4, 6.8,
Right.
meaning you are the most sheltered against the negative effects of inflation. And actually, inflation helps you, especially when we fix the debt.
That's one of my favorites.
It's fixing the debt.
Yes, absolutely.
Ryan, talk about fixing the debt.
Well, I don't want to say you can't lose, but look at it this way. If we have debt fixed at 7%, 6%, whatever it is, if looking forward, and so when we lock in our debt, and I think that's something that makes us unique with our long-term approach,
Yes.
like we mentioned earlier, but we like to lock the debt in as long as possible,
Yes.
even if it's a higher rate,
Yeah.
because it gives you certainty.
Right.
As opposed to operators that a couple years ago, oh, this is great, I can get a 3% loan. Variable, don't worry about that variable part.
Floating rate.
Getting bit hard right now, getting destroyed because rates go up to 8%, that 5% smokes you. Your return is gone. Versus if we know, all right, we're going to budget out, we're going to have a 7% return or 7% rate for the first 7 years. Well, one, if interest rates go down, wonderful. Let's go refinance. We structure our loans so that we don't have fees to refinance, no prepayment penalties. If interest rates stay the same, well, great, it's exactly what we predicted, numbers work, no problem. If interest rates go up, are we smoked? Well, we have 7 years to pay down the debt,
Yep.
increase the rents
Yep.
or other revenue streams, whether it's operational efficiencies or utility bill backs to increase that value. So if your debt's paying down, your value is going up, you still have your debt to income or your
Yeah. DSCR.
loan to value ratio,
Yeah.
et cetera, right, all in line, and you can refinance, you can afford to pay that higher rate down the road and still have your returns if that happens.
Yeah.
So
Easier
to me,
absorb it.
you absorb that, you can absorb it. If you have to, that's your worst case, obviously. If rates go crazy, if they go up a half a point, whatever, no big thing. But that is all about that risk averse approach that we take, and eliminating the risk anywhere we can, or eliminating or limiting the risk. I mean, you can't say there's no risk in the whole thing. Of course there is, and everything. But that's just, it's frankly fun to me when you put yourself in that position by setting it up right off the get with your debt structure. That really makes it kind of a no-brainer.
It's a huge risk point that, when I go to these conferences, whether it's Best Ever out in Salt Lake City, or it's other conferences, went to some in Louisville and Florida, all over the place. Operators that don't do that are playing with floating rate.
You are
debt
playing
and
with
stuff like
fire.
that. You're playing with fire, but you're losing the point of what you're actually doing. You're
Right.
confusing it. Because when you do that, by default, you're trading debt.
Yep.
We're not debt traders.
It's important to understand. I
We're
agree. That's right.
multifamily operators. We want to be extremely good at that. And we're not interested in, can we make an extra % or two here from.
The quick buck.
Yeah.
Yep.
And there's a lot of people who are in the syndication business and they have 5-year hold horizons. Not that that's bad, but a lot of times I view it as, and I think it's more like you have a 10-course meal and you decide only to eat half of the dessert. Maybe
Sure.
not even the whole dessert, right? You're like, I can get a 1.9 multiple, meaning I make 90% of my money
Right.
in 5 years. And it's like, okay, cool, man. But if we hold this for 10 years, maybe we can make
You could maybe do that twice.
3.5.
Yeah.
Okay. I don't have reinvestment risk, meaning, okay, once we sell a property, now I have to invest it again, or I have capital gains tax.
Right.
Okay? And I got to go find another good investment. Well, if you exited a deal last year in the beginning of the year,
Right.
where are you going to find another deal?
That's right.
There was none to be found. So then you're going to go overpay.
You're forced into that situation if you're trying to avoid that tax hit.
Yeah. And so we want to be in a position where we have as much control and say over what we do as possible. So we're never forced to sell. It's always
Right.
on our terms.
Right.
We're never forced to buy. We only buy when it's advantageous. And I mean, since we're investing our own money, that's how we feel about, people who are partnering with us to invest in the deals that we do.
That's right.
So I think that's, I don't know, it's super important to me. What are some things that you see that we look at when assessing a property? What's most important to us?
Sure. Wow, gosh. And how to rank them. Okay. Just start from the top down. First thing when I see an opportunity, you're going to look at the price and number of units. Start there. Next thing my eyeballs are going to, and that's broad strokes, of course, off the top. Next thing my eyeballs are going to is location. Example being the Toledo market. Toledo's got some pockets.
Yep.
Some good pockets where you want to be.
Sure.
The concern is always, is that still going to be a good pocket in 10 years,
Yep.
20 years? Is it going up? Is it going down? Where has it been? In any market, just as an example. And then I'm going to look at of course, the maintenance and how the current owner operator is taking care of that place and what's going to need done. And that really goes in conjunction with then, of course, all the rest of the details with what their cash flow is, what their expenses are, get that information. So there's all kinds of things that go into that, of course. But then all of that really quickly in the first pass boils down to, okay, what's our opportunity here?
Right.
Because if it's a place that has, the rents are maximized and it's in good shape, nothing that can be fixed up and that nature, capital expense wise, they're maximizing their utilities set up. What's our move there?
Right.
If they're operating it fairly efficiently, probably not going to go after that property.
Yeah.
Because it's already top dollar value, and what's your return going to be? You don't have a mechanism there to increase that return.
Right.
So I like to always look for, okay, what's the hook here? What angle are we going to go in, and are they overpaying for their operation, or can we either go in and improve the property on the exterior or the interior, or what's going to add value for these tenants where you can increase those rents, or are they just, frankly, I think we've seen a few, and I think we're going to see more of family-owned, smaller operations that simply aren't maximizing the asset.
Right.
They have it under-rented because they don't have any debt, or they have very low debt. We've seen some of those. I think we're going to see a lot more, and those are key to look for because we can get that family, that individual out of it who's sick of operating or done operating it they've had it for 30 years or whatever the case may be.
And
Get
we can
them
help
out
them
at a good price, help them.
exit in a way that is advantageous for them in
Absolutely.
tax liabilities
And
too.
Yes, and I don't anticipate, I would not enjoy grossly underpaying for something just to hose somebody over.
No,
Put it
no,
that
no,
way.
no.
That's not the
That's not how
deal.
you do
It's
good
not how we're
business.
operating.
No.
Exactly. But fair price gets them out, gets them what they want, and then gives us an opportunity to go in and take advantage of those opportunities.
Yeah.
Right? Whether that's, okay, well, like one we've done where we were stuck in some older leases, some of the originals that we just had to work our way through and get there, or that rents can be raised quickly, or there's a utility bill back situation or operational inefficiencies. All those scenarios just lead to return and stabilize that property, stabilize the returns, and then you're off and running.
Yep. And we don't look for, we're mid-market properties is what we look for. 40 to
Or a
100.
Rust Belt.
Yeah, 40 to 150 units is pretty much what we're looking for. If it's a really good property, we might look over 150. But that's kind of where we're looking for. And we're not looking to take on projects that are really heavy lifts, 70% occupied or anything like that, because
Right.
that's outside of our risk appetite.
Yep.
You know, we want to be able to step in day one and hopefully, or not the first quarter, but the second quarter, send those distribution checks. Like,
Right.
it's what we do. We haven't missed one yet. Hopefully that never happens, that we miss any. And that's how we operate. I've gotten this question before, and I think it's valuable to ask. Right now, we operate primarily and invest primarily in Northwest Ohio. But I think we're open to expanding outside of Northwest Ohio
Sure.
once we finish building the base of,
That's right.
of our
I agree.
portfolio.
I agree. And we want to have that stable base portfolio that provides the returns for our investors, ourselves, sort of on both sides of the thing, but the stability for Rust Belt to really build out the operation and the management thereof. Not opposed to looking at different markets, but obviously being very selective and seeing those opportunities in those markets is the key. And there's no reason we can't scale outside of our current geographic footprint.
Absolutely.
Just a matter of getting that base set up and finding the right opportunities. Yeah.
Yeah, and I think this is a good point to talk about is scaling. Like, there's a lot of companies who got into this business and they cared about scaling,
Right.
scaling. And so they scaled really fast and they wanted fee income.
Sure.
We're not here to make our living off
We're
of
not
fee
here to
income.
feed people to death. That's right.
And now they're in trouble because they scaled too big. They don't have the correct operations to run the assets that they bought. They didn't understand the debts and how to mitigate as much risk as possible.
Right.
Debts turning over on them.
Now they got a problem.
Now they got a huge problem.
Right.
And so we see their properties come across our desk of, hey, these guys are blowing up, and those investors lost all their money.
I'm happy to help them out, take them off their hands, but yeah.
If it's advantageous.
Right.
And then I've also seen people that got excited about hot markets.
Right.
Because it's the it thing. Like, we're not trying to chase a fad. We're not trying to invest in NVIDIA because CNBC all of a sudden wants to talk about NVIDIA.
By then, it's just not. It's too late, right?
Yeah.
Yep.
And I think I made a video recently saying, you're not going to get rich buying NVIDIA. You never were. And it's not that NVIDIA isn't a good company. It's that if you're chasing NVIDIA, it's a personality flaw that's causing you to not. Because, 100% gain followed by 100% gain followed by 100% loss is zero.
That's fair. Yes.
Okay? And so if you're chasing GameStop, you're chasing AMC, if you're chasing NVIDIA,
Right.
okay, the likelihood of you actually creating
Timing it perfectly.
perfectly or creating significant wealth is very low.
Right.
But if you look at the returns of Warren Buffett or any, 1% investment company, they're like 15, 20% a year.
Sure. Stability.
So if you can hit 15, 20% a year, like, those are the best investors of all time. They're not chasing the 10 baggers.
Right.
They're trying to buy good assets and put together a product, which is what we're doing.
That's
But
right.
to the point that I was getting at, look at Austin, Texas. Austin, Texas was
They were hot.
the who's who.
Yep.
Everybody wanted that. People were just falling over themselves.
Yep.
And they were chasing capital appreciation.
Uh-huh.
How's it look now?
Uh-huh.
Rents are
Different
only
story.
not growing. They're going backwards.
Yep.
They got too much supply. All the development is not materializing as quickly as they thought in Austin. Is it an okay market? Sure, whatever.
Right, but it is. They've got their struggles. Yes, it is shrinking now.
Yeah. And there's other places like Phoenix. Phoenix is a cyclical market. Yeah, they might have, Taiwan Semiconductors building something in Phoenix, I believe, or whatever. And that's cool, but you got to understand that where you are in those market cycles and not overpay for stuff, not chase things because people are, it's hot and sexy and glamorous.
Right.
And a lot of people who bought the Class A huge properties are now underwater.
Well, and that covers really kind of circle back to 2 points there. One is our geographic footprint, where yes, now we're in Northwest Ohio and it would go further, but keeping in mind that there are larger markets not too far off from us: Columbus, Cincinnati,
Indianapolis.
In those markets, though, you've got money from there's a lot of people. It wouldn't just be us, right? There's
Right.
other operators. There's East Coast, West Coast money operating there and trying to grow there in those hot markets, right? And that's a cause for concern.
Yep.
And particularly are you going to overpay?
Yep.
And overpay significantly,
Right.
perhaps. And not that we need to focus solely on smaller market areas, but there's a lot of room there. There's a lot of smaller cities that we can find that we know are out there that can have some serious upside that aren't getting as much attention as those larger markets as far as geographic footprint goes.
Yeah, it comes down to operations. Like if you know how to operate an asset and you can operate it more efficiently than anybody else, that's going to be able to save you in times that everybody has to suck and wind.
Absolutely. That's the other point that I wanted to feed off of what you were just saying with our time frames. You know, if you're looking for that asset to appreciate quickly in those hot markets, that's one strategy. You know, people do that. That's not our approach.
No.
It's never been our approach. That's never going to be our approach.
No.
Our approach is long term. It's not to leave that. You know, we see the other syndicates that are structured so that the operator gets paid more the faster they hit certain targets, right? Whether they get 10 or 20 or whatever percent return to their investors, which is nice. That investor gets that nice return on a relatively quick basis, but then that's it. That's just to your point, hey, going eating your dessert and leaving the whole fillet and everything else on the table there.
Mashed potatoes,
right?
green beans.
I mean, those things are good too, but I want the whole meal and stay from the hors d'oeuvres to the to the late night snack.
There you go. We want a nightcap, man.
Because why leave all that on the table when instead of chasing that quick return, which again you just have to find another place to park your money. You've got the capital gain to deal with, and that's unnecessary. And frankly, it's not our approach. Those are also, keeping in mind, designed to return more on a fee basis to that operator, and that's again not our approach. We want to be on that investment side with our investors, and I think that's a big differentiator.
It's not to say that you can't make a meaningful amount of capital appreciation and realize it with us, because
That's right.
we could do cash out refis.
Absolutely.
But we don't get paid more because of a cash out refi.
That's right.
And honestly, I think a lot of other syndicators also have it. It might be different from company to company, but they don't get paid either on a cash out refi. So they might be incentivized to sell it when the best thing to do is to do a cash out refi.
Yeah, and that is when it gets really fun. When you have an investor, say invested 50 grand with us, and 5 years later we can say, hey, here's your 50 grand back.
Yeah.
In addition to all the dividends you've received over the last 5 years, and you still receive those dividends.
You still own that.
You still own that piece, and you get your 50 grand back.
And here's your 50 grand.
You want to go do it again?
Tax deferred.
Take that 50 grand, let's go do it again.
Yeah.
And then let's keep it going. That's a lot of fun.
That's when you get the exponential growth.
That's right.
You're not forced to sell the asset. And so that's something about the stock market is like if you want to realize a gain. So say you go invest in the S&P 500.
Right.
Today it's paying a dividend of 1.4%, something like that. Our dividends are substantially higher than that, obviously. Usually they should be. But in order for you to realize the capital appreciation, which is your whole like banking on in the S&P 500, is you have to sell the asset.
Sell that asset.
If you buy Microsoft stock, in order to make money off Microsoft, you have to sell Microsoft, and then you're done. But with our multifamily deals that we're doing, you don't have to sell the asset. You can get the money back, and then you can go do it again. It sounds like illegal or something, like it's some voodoo stuff, right?
Put the disclaimer in there.
Yeah, voodoo. We're practicing voodoo over here or something, but I don't know why that wouldn't be super, super appealing.
Agreed.
And so,
it is.
People say, hey, you can't outperform the stock market or stuff like that, and 8% is the return. And it's like, okay, back to good assets, leveraging time thing. If we buy a good asset and it's supposed to return 8%, and we're paying 100% cash for that, if it's a good asset and we hold on to it long enough, and we borrow some of the money to pay for it instead of not just cash, why wouldn't you have a higher than an 8% return? So it's like structurally logical for us to do better than the 8%.
Agreed.
If you're interested in seeing the offerings that we have, the investments that we have available to our investors, the best way to do that is to go to our website, www.rustbeltcapital.com, go to the footer, and in the footer, there's going to be a Contact Us form. It's going to ask for your name, your phone number, and your best email. Submit that. You're going to start getting some emails from us, and then you'll get emails once a week from us, and it could be pertaining to investments that we have coming up, offerings, stuff like that. And if you're really interested to talk more, reply to that email. It'll come to us, and we will reply back to you. And you'll be in the know on the offerings that we have, and you'll be up to date on seeing our track record. We'll send you a case study, all that type of stuff. So that's rustbeltcapital.com. Go to the footer, put in your information, your name, your phone number, and your email.
Gotcha.
And we'll be in touch then.
Excellent.
So, yeah, I hope to see more people and hope to help them make more money, man.
Love it. That's right. That's what we're here for.